Hey everyone, this is Brian from Green Springs Capital Group bringing you a weekly update. So today we're going to talk about tax deference. We've already talked about asset appreciation and we've also talked about cash flow. So the third pillar in our investing strategy and what we love so much about real estate at Green Springs Capital is tax deference. So the easiest way to explain this is maybe to go through an example. These are just made up numbers, but for ease of calculation. So say you have $1 million property and you generate $100,000 a year of gross income from your rents. So after you pay your debt service, which is your mortgage payment, you might end up with $50,000. Okay, so you have $50,000 in profit. So normally if you made $50,000 at your job, you would pay taxes on $50,000 at your income tax rate. In real estate, it's a little bit different though. So you have $1 million property and you're allowed to depreciate that asset over 27 and a half years because it's residential real estate. So if you have $1 million property, you back out the land. So say the land is worth about 20% of that, you end up with $800,000 in asset value. You divide that by 27 and a half years, and give or take, that's about $29,000 a year in depreciation. So depreciation is a loss on your income, even though you're not actually losing anything. It's the assumption is the building is losing value every year because it's deteriorating. So if you have $50,000 a year in net income after you pay off your mortgage, you have $29,000 now of losses and depreciation. You only end up with $21,000 in actual taxable income, yet you still have $50,000 in your pocket. So this is what's so wonderful about real estate is you're deferring taxes. So that means you're eventually going to have to pay them, potentially, but you have the money in your pocket today that you can go out and reinvest and keep reinvesting and reinvesting and reinvesting. What we love so much about this tax deference strategy is it keeps more money in your pocket, less money paid out as taxes. And if you continue to gain your, a sizable return on your investment over year, your net worth and your valuations on your properties will only be that much better. In short, appreciation is a fantastic mechanism for wealth creation. And next week, we'll talk a little bit more in depth on something called a cost segregation study that will even defer more of your taxes on the front end. But for now, that's it for this week. Thanks for joining me and have a great weekend.